Hey friends, Lucian here with the Bullish Bears team, making this video on day trading strategies for beginners or long-term trading, whatever trading in general. The most important thing that I could really stress to you is make sure that you have proper risk management strategies in place. Risk management is more important than anything. All the technical analysis and fundamental analysis in the world will not help you unless you have proper risk management strategies. And risk management in it is basically, in a nutshell, is defining your entry and exit strategies before you ever enter into every single trade. It's every trade, not just once in a while, not here and there, not kind of guessing, but every trade. You need to know what you're going to be risking. You're going to want to see, basically whatever your entry level is, you also got to see where your exit strategy is going to be as well, right? So buying at support, ideally, and selling at resistance areas. Now, with risk management, you want to have at least, right up here, at least a 2-to-1 profit-loss ratio. So basically, if you're risking 10 cents, you want to be able to make 20. If you're risking 50 cents, you want to be able to make $1. If you're risking $1, you want to make at least $2. Now, ideally, you want to get, higher profit loss ratio, 3-to-1, 4-to-1, 5-to-1, but at minimum, you want to have at least 2-to-1 so that your gains always outweigh your losses. Now, what a lot of traders will do is, especially newbie traders, they come into the market, they don't define their risk, and they're trying to make, let's say, 10 cents on a trade, but they might be risking 50 cents, right? Because they don't have predefined stop losses and areas that they're planning on getting out. So, hey, they're thinking, hey, I want to make 10 cents, and they're risking 50 cents, right? Or they want to make $1, but they're risking $2 or $3. That's a negative profit loss ratio, and you don't want to do that. So it's so important on every single trade to always define your risk and have at least a 2-to-1 profit loss ratio. And again, too, a lot of people, traders that come into the industry, obviously we all want to make money, right? You want to get rich, you want to get rich trading the stock market. But the harsh reality is, it's a statistical fact that 90% of traders fail. And that's, unfortunately, there's no way around it. That's just a statistical fact. So the only way to become a part of that 10%, there's no easy fix. It takes hard work. It takes hundreds of hours, hundreds of practice trades over months, if not a year plus time to become a good trader. There's no way around that. And that's why we recommend coming over and setting up a virtual platform. Again, we recommend Thinkorswim, but Interactive Brokers, they have a decent platform as well. Whoever you use, make sure that the platform that you use has a good virtual trading account to be able to get started and practice with. I'm going to show you another platform that you can see here. This is DOS Trader. Now, I personally use Interactive Brokers for my brokerage account, and then I use DOS Trader. I pay about $150 a month to get this set up to trade with Interactive Brokers. Just because Interactive Brokers, their platform is decent for day trading. It's not great. The hotkeys are much better with DOS Trader, and the trading montage, which is this level 2 area, which I'll get into, and time and sales, looks a lot better. But I still use Thinkorswim for my charting just because I really like Thinkorswim charts better. But Interactive Brokers, again, they're a really good broker to be able to use. They have a decent, they actually have a pretty decent virtual platform. So if you don't use Thinkorswim, Interactive Brokers has a decent one, and you can set up your virtual account. It looks very similar to this, a little bit different, very similar, just the difference being is their hotkeys are not as editable and good as DOS Trader, and the level 2 is not as clean and nice looking. But again, you got to pay for this platform. It's about $150 a month. But if you're trying to get started, you're new, you're trying to learn day trading or just trading in general, then open up a Thinkorswim account, followed second by Interactive Brokers, and just get ready to make hundreds of practice trades. Right? It's just no way around it. And just to show you guys right now, currently we're using Skype for our trade room. We're going to upgrade and probably go to a different service, but basically what you would do each day, right, is you come over and, come over to our website right here, right? You subscribe to our email. We send you out a watch list with alerts every night, right? Then you would join our trade room, and then every morning what you would do is you would have your watch list. You would take the watch list that we create at night, upload it into your own brokerage account, whether you use Thinkorswim or Interactive Brokers, and you're watching, obviously, if you're doing day trading, watching pre-market, the volume, watching what's happening. We also send out trade ideas. Now, trade ideas is hands down our favorite scanner of choice. Thinkorswim scans are pretty decent. Our trade ideas is the best. We do have a community discount, Bullish Bears community discount of 15%. We have the links below. If you want to be a really good day trader, you need an awesome scanner. There's no way around it. Scanners basically are the heart of absolutely everything with trading. You can't find these plays without scanners. So again, the link below to trade ideas, we have it again with our 15% discount. Bullish Bears 15 in all capital letters is our promo code. Also on our website, we have a banner right here with trade ideas. Again, we basically can't trade without trade ideas. It's the best. So again, in the morning, what we would do is we'd look at trade ideas and we'd see any pre-market movers that are happening, and we check out the ones that have the highest gap percentage. So what we do, this is an idea of what trade ideas looks like, right? So trade ideas in the morning, let me see, there we go. You'll see we kind of have it set up like this: a stock symbol, we have the price of the stock, the float, which is the number of shares that are able to be traded, the volume today, and then highest gap percentage, right? So what we do is we take our watch list at night, we upload it again into our Thinkorswim watch list area over here, and then we check trade ideas and see what's moving, right? We look at the highest gappers, we look at the ones that have volume, and then a lower float. So that's a whole other thing. Float is basically, again, the shares that are able to be traded. Anything under 20 million is considered low float. Under 10 million is really low float. So under 10 million and under 20 million, lots more volatility, lots quicker moves up and quicker moves down, more risky, they move a lot quicker. Anything above 20 million, 50 to 100 million is kind of like medium movement, and then over 100 million float tend to be slower. So if you want more risk, obviously equals more reward. The low floaters, medium is kind of a medium trade, and then high floaters are more of a slow move. So again, we look at the highest gap percentage in the morning, and then we see volume, right? Sometimes a lot of times, if you get too much volume pre-market, 1 million up or upwards or more, 500,000, 1 million, a lot of times they'll completely jump up pre-market and then crash when the market opens. So ideally you want to have around 10,000 to 100,000 in volume, but it doesn't mean, it's not a rule, but the rule is you want to have at least minimum 10,000 volume, upwards of 100,000 or more, because that means it's usually a news catalyst driving it, right? Then you look at the gap up percentage, the float, the stock, and then you pick, a handful that have some decent pre-market charts, and you add those onto your watch list over here. So you kind of have, a mix. I have a mix of my nightly watch list with targeted with, trade ideas. And basically what you're looking to do is you're looking for, let's go over here, right here. You're looking for daily breakouts, right? With minimum overhead resistance. So what you're looking for is stocks that ideally have a news catalyst. Sometimes they don't have a news catalyst and it's just a technical breakout, but you're looking for stocks that are breaking over key resistance areas on your daily charts. Now, what is resistance? Well, resistance are previous areas where the sellers took profit. They're kind of like a ceiling where a stock might have trouble breaking through. Support areas are a base where the buyers kind of come in. So buyers will come in after a stock sells off, will come in and create a support area. Or resistance areas where the sellers take their profit and it's having a tough time breaking through. When a stock breaks resistance, that resistance area now becomes a support area. When a stock breaks support, now that area of support becomes resistance. So it's all about support and resistance, buying low, selling high, right? So as you can see here, support and resistance. And all of these support and resistance areas, they basically are, they are formed by candlesticks, right? So candlesticks form, I'll show you here, candlesticks all form patterns, right? And those patterns tell a story, right? The candlesticks are basically always the battle of the bulls and the bears. Green candlesticks are bullish, red candlesticks are bearish. Bullish means stocks going up, bearish means stocks going down. So you can see all of these little candlesticks tell a story, and then in that story, you look big picture, there's patterns that are created, and you'll see traders pay attention to patterns. They're creatures of habit. Again, I want to point you over to this reference of over here. You can see under stockcharts.com, you could read all about candlesticks over here. You can have a whole candlestick course. I would encourage you to go through all of this on candlesticks, and it's going to take you, again, I wish there was an easier way to do this, but it's going to take hundreds of hours of studying, hundreds of practice trades over months, if not a year. So that's why we want to encourage you, open up your virtual account, study. This is like a college education. You're going and you're going to invest hundreds of hours of learning, and you're going to invest hundreds of hours of practicing. But the problem is most traders, when they come into trading, they want to make money, so they use real money. And again, 90% blow up their accounts and quit. It's just it's a statistical fact, and we don't want you to be a part of a statistic. And that's why we've created a community where we're different. We're not membership based. We do everything based upon donations. So if you look right now, we are a donation-based community. So all of our trade room, our watch list, our alerts, our courses, our community, everything that we offer, it's free to everyone that follows us, but we do rely heavily on donations. So if you'd like to donate to us, if you click on our donate tab, you'll see we have donation options for as low as a cost of 1 to 2 trades a month. We're just looking for everybody to give a little bit, not everybody to give a lot, to kind of help keep our movement growing. So again, the more people that donate, the less likely that will be membership based. Well, there's no guarantees. Someday down the road, we may be membership based. We might charge membership fees, but we ideally don't want to. That's why we rely on donations to keep things growing. All right. So again, my point being in all this is we provide all of this content to you because we really want to help you to become a good trader and give you that support, again, that community that helps you out to really learn with trading. So going back over here again, proper risk management, 2-to-1 profit loss ratio. Looking for stocks with daily breakouts with minimal overhead resistance. And you want to look at support and resistance area, and those candlesticks create patterns, and traders are creatures of habit and they pay attention to those patterns, right? So again, when you look at a daily breakout, when a stock's breaking out on a daily, you're looking at a daily chart. Obviously, depending on how long you're looking to go. Again, if you're a day trader and you're looking to do day trading strategies, typically you're looking at a day chart, looking for a stock that's going to break out or break down on a daily chart. And then you're going to look at an intraday time frame. either a 5-minute chart. Some people will do 5-minute charts. Some will do 1 minute. Now it's a matter of preference. If you're looking in and to get in and get out very quickly, and you're a scalper, then the 1 minute's going to be a very popular chart. If you're looking to kind of slow it down a little bit, almost do like a day trade with holding it a little bit longer, then the 5-minute chart might be what you're looking to do. But the best setups are typically ones that have a breakout on the daily and then have a good 5-minute chart setup with an entry on a 1 minute. So if you get a good breakout on a daily and you have a good 5-minute chart setup and you find your entry on a 1 minute, that's typically your best setup, right? So that's kind of like, again, there's not necessarily a particular rule. Like, again, a stock could completely run with a terrible 5-minute setup, but if you want to be the safest and trade the safest way, you want to find, again, stocks that are breaking out on a daily with a good 5-minute chart setup and getting a good entry on the 1 minute, right? Now, also, too, a stock that has a news catalyst, if something has news or breaking news, that's a huge catalyst in a stock moving up. Now, again, stocks will have technical breakouts sometimes. They're a little bit more riskier, meaning like if there's not necessarily a catalyst, it's just a technical breakout, be a little bit more careful with those. But with anything with day trading, you always have to be careful. Always take your profit. Don't get greedy. That's where, again, the risk management comes in. Look at predefined areas of support and resistance. Again, candlesticks will create support and resistance. These wicks and these candlesticks will create resistance areas. So like a resistance area, right? Here's a support area. So you'll see it's a stock's having a tough time getting past this resistance area. And then the support area, the buyers are coming in, it's not falling much below it, right? Then you'll see something like this on a stock like this. You'll see there's a gap, right? There's a big gap between here and here, right here. See this gap? Technically, they say, traders will say all gaps must be filled. Again, it's just a matter of when. It could take months or years, but traders pay attention to these areas, and you can see the stock had a daily breakout over here, went up and filled the gap, pulled back, and now again, sometimes the stock will continue up or it'll fade back down. But every time a stock breaks a resistance area, now this area, see when it breaks through here, now it becomes support. When it broke through this resistance area, now it becomes support, right? Then you can see a resistance area here. Now you're going to see if the stock is going to break above or whether it's going to fall back down. Again, it's all a matter of support and resistance, looking at patterns, right? Studying patterns. There's no easy way to teach this. I kind of liken it to the analogy of those magic eye pictures, right? Remember those pictures where they look like a whole bunch of little dots, right? And then you have to train your eyes to see the picture inside of the picture. That's basically what looking at support and resistance is like in these candlesticks and the patterns. It takes so long of just studying hundreds, if not thousands of charts. And then one day it just kind of like your eyes adjust and then you can finally see that picture within a picture and you're like, oh, wow, I can totally see those patterns now. That's what it's like with, looking at support and resistance in these patterns. It takes looking at hundreds and thousands of charts and then eventually it hits you, the picture within the picture reveals itself to you, and then it all starts to connect. Again, I wish there was an easier way to do it, but it's going to take hundreds of hours of just practicing. Again, wish there was a better solution, but there isn't. So going back over here, you'll see here again, support and resistance. And again, Investopedia and StockCharts.com are great resources. Volume, liquidity is the key. When you're looking at stocks, volume is the amount of people coming in to either buy or sell the stock. You'll see all these volume bars, right? The higher the volume bars, the more volume that's coming in, that gets the stock to go. The lower the volume, either it's forming like a bull flag or some consolidation, Or, depending on the stock, if nothing's happening, nothing's going on. But looking at big volume bars is very key. You can see like these big volume bars, they tell a story. Again, so then you're looking at volume on a daily, right? Huge volume spike on a daily, right? That's a big deal. If you look over here, there's only a handful of spikes this year in volume. That volume bar is telling a story. And then those volume bars within the intraday also tell a story. So you want stocks that have lots of volume. Now you can say, well, what's the proper amount of volume to look at? Well, there's not a real perfect gauge to really give you. Like, you want at least a few 100,000, 300,000 or more. Sometimes the problem is when you get a stock like with under 100,000 volume, or even up to 300,000, it could be just very volatile and hard to trade. So you ideally want to have at least a minimum of 300,000 intraday to trade. Obviously, the more, when you get up to a million or more, it's a lot easier to trade, because someone buying or selling is less likely to drastically move the price of a stock. So if only 100,000 or less shares are traded, and somebody sells 10 or 15 or 20,000 shares, that's going to really drastically affect the movement of that stock. But on the flip side, if a stock has a million more in volume and someone sells 10,000 shares or so, it's not going to drastically affect things as much. So volume is very, very important to take a look at. So these are volume bars, right? The higher the bars, red or green, obviously tell a story. Green are the buyers, red, are the sellers, big candlesticks, right? Sometimes you'll see big green candlesticks intraday, and the candles are not that big. But again, these candles tell a story. And again, you're looking for breakouts on the daily, and then looking your entries and exits intraday. All right. So let's go over to limit order versus market order. So a limit order is basically you're going and you're setting a certain price that you're looking to buy the stock at, and you're basically saying you don't want to pay more than that specific price. Market order is basically saying you're looking to just get in that price of that stock as quickly as possible. We highly recommend using limit orders and not putting an order out to the market, because when you buy at a market, that means you can see the price right here. You can see bid and ask. Bid are the buyers, ask are the sellers. This is open, but that's really ask. Let me show you again over on DOS, maybe a little bit easier to look at. On this side would be buyers, this side would be sellers. You'll see bid over here and ask. So bid are buyers, ask are the sellers. And the last price is $3.39, right? If you put a market order out, chances are it'd be filled somewhere right around here. But if this is a crazy volatile stock and you have huge bid ask spreads, the price of the stock could change really quickly. And if you put a market order out, you could get a really bad fill. So putting a limit order is basically setting the price that you're looking to pay, the most that you're looking to pay. So this is kind of how it looks over here. This is how I put my limit orders in. This is using DOS. Interactive Brokers is very similar. With Thinkorswim, it's a little bit different. If you go to the trade, there's several different ways. You can hit right click and hit buy. Then you can kind of go in, you can edit it here, and then kind of put a limit order here with whatever price that you're looking to buy at, right? Or you can change it to market. So you see market order, or you can do limit order, and then you would confirm and send and make your trade, right? So again, we highly recommend using limit orders. Again, take our course, take our basic stock course, watch our videos. We'll have them more attached in our course. But limit order basically sets the limit of what you're willing to spend to buy and to exit a trade. We highly, highly, highly always recommend using limit orders. If you don't get your fill, you don't get your fill. At least you're protecting yourself. So next thing, bid-ask spread. The tighter, the better. Now, a lot of times with these low float stocks, the bid-ask spread might be kind of wide. I like to have, a 1 to 3 cent spread. So you can see 845, 846. That's a penny, right? I like a tight bid-ask spread. Let's see if we can find one that has a low float. So the higher the float, a lot of times the bid-ask spreads tend to be tighter. Sometimes a lot of the low floaters might be 5 or 10 cents. Doesn't mean you don't trade them. It's just you got to be very careful on your entry. And if the trade goes against you, get out, take your loss. That's, again, going back to risk management, cut your losses is the biggest thing that we can stress, because, even the best traders in the world, they still fail, 30 to 40 to 45% of the time. So basically the best traders in the world, they succeed on their trades 60 to 65% of the time, maybe 70%. So again, 30 to 45% of the time they make losing trades. But the reason why they're successful traders is they cut their losses. Losses are part of the game. It doesn't matter how good of a trader you are, you're going to take losses. So let's see over here. Okay, perfect example. Here's a very low float stock, right? Look at this bid-ask spread, 467 to 499. I mean, that thing's just so hard to trade. That's a crazy volatility. That's bad, right? You don't want to do that. And you can see, look at what it does in the daily, right? You have a breakout, all right, a breakout and then a breakdown. It's so hard to trade something like this. Massive volume, but crazy bid-ask spread. So that's an example of a very huge bid-ask spread. Sometimes, again, on the low float ones, sometimes you'll get, 1 to 3 cents, and that's good. But it doesn't mean a 5 to 10 cent is bad. It's just all depending on what the catalyst is. That's why you want to use limit orders to get into your trades, because if you don't and you just did a market order on something like this, perfect example. If you put a market order and it filled at 483 right now, well, what if that thing, just literally drops back down to 450 again, right? You just lost 30 something cents so quickly. That's why very, very important to do limit orders. Stop losses. Ideally, you want to press sell yourself, because again, there's this kind of this conspiracy thing that market makers see your orders. Now, they do see your orders, they can see your stop orders, but sometimes, again, these brokerage firms will say, oh, they don't put the stop orders in the system, so market makers can't see your orders. Well, I mean, I don't believe it. I believe that I kind of go on the theory of market makers can see your orders and they will try to trigger your stops. So the way I, basically like to teach people is that's why you want to practice hundreds of trades in a virtual account, so that you can feel the emotions of making a trade yourself. You can feel the goods, you can feel the bads, the positive, the negative emotions that come with trading, because they're there. It's filled with lots of emotions, and that's why you want to ideally be able to press buy and press sell yourself, not just rely on a manual stop in the system, especially with day trading. Again, if you're working and stuff like that, sometimes you have to have a stop loss in place, and that's okay, but that's where you're going to have to practice making lots of virtual trades to see where your comfort level is. But again, with day trading, when you're getting in and out of a position, you can see, just look at this stuff, right? Look at these wicks and shadows. See all these things? These are just like, a lot of times it could just be taking people's stop losses out, all of this, right? All of these wicks and shadows up and down, up and down, up and down. If you have a stop loss in place, it could easily smack down and hit a stop and bounce right back up. That's why looking at candles and closes along with these moving average lines is very important. So again, going back with support and resistance, not only are candlesticks and the wicks and the gaps areas of support and resistance, but moving average lines, all these lines that you see here are all support and resistance areas. So make sure you watch our videos on moving averages and our our day trading course, the simple moving average and the exponential moving average. Again, they all create stories of support and resistance. So again, ideally with a stop loss, you want to ideally press that stop loss yourself and not have your order in the system unless you have to. But especially with day trading, you need to train yourself to be able to press that buy and sell yourself and be able to take the loss, take the gain, become emotionless. That's super important to learn. Level 1 and level 2 with time and sales, right? Level 1 is right here, right? This tells you the price of the stock, and then the bid, and then the ask, the number of buyers and the numbers of sellers, right? I'm going to show you over here on DOS. I kind of like it better. This is where I like to trade with. You can see level 1 right here. You can see level 1, buyers on the left, sellers on the right, bid and ask, or over here, buyers and sellers. So this is level 1 right up here. It tells you the price of the stock right up here, and then the buyers and the sellers, the volume, VWAP I'll get into. You could also see it down here. But this is level 2, right? So this is level 2 in time and sales. Give you another look. TD Ameritrade's level 2 I don't like very much. It's not as in-depth. Their level 1 is good. Their level 2 is not as in-depth. But time and sales are the orders that are coming through. So the green and stuff are the buyers. The red are the sellers. And you'll see the number of orders coming through, number of shares. Over here, it shows you the number of buyers versus the number of sellers and what price that they're coming in at. This tells a story. Again, candlesticks, EMA, support, resistance, level 1, level 2, time and sales. It's all part of a big picture. Now, many times, level 2 will get manipulated. There'll be fake buyers and fake sellers coming in. That's why it's important to look at time and sales and see if the actual orders are coming through. Again, not completely accurate on everything. It's a whole gauge on everything. The most important thing is candlesticks in support and resistance. There's absolutely no way to predict what a stock is going to do. No matter what you do, no matter how you set things up, all it takes is one trader out there in the world to mess the entire trade up. One buyer coming in when massive people are selling, or one major seller coming in when buyers are there to really drastically affect the price of the stock. That's why it's important to look at, a whole big picture, candlestick, support, resistance, the level 2, time and sales, the buyers, the sellers, watching what's happening, and just take a look at it like a big overall picture. So time and sales in level 2, again, level 2 are the buyers on the bid, sellers on the right. The number is number of shares. It's usually times 0, 0. So 10 would be 1,000. 11 would be 1,100, 12 would be 1,200, and then you got to see if those orders are coming in over here. When you see a wall of buyers coming in, that's potentially a good sign. If there's lots of quantity, you can see the quantity. If there's 100 shares, that's not a big deal. But if you see, 5,000, 10,000, 15,000, 20,000, that's a huge deal. So you got to train your eyes and train your emotions to be able to see all of this in real time. This is slow right now. I'm making this video after 11:30. It's starting to slow down a little bit, but when the market opens, this thing can move at a rapid pace. Again, if you say, well, that's very overwhelming, I don't know how to get used to it. Well, it's going to take hundreds of hours of practicing to really get comfortable, and that's why, again, use a virtual trading platform. So, EMAs and SMAs, exponential moving average, simple moving average. So the most popular EMAs are the 9 and the 20 EMA, right? Those are the most popular. Now, the 13 EMA is also very popular. So if you're using the 9 and the 20, I wouldn't say you'd really need the 13. But if you're using the 13, it's the kind of the in-between between the 9 and the 20. So some will use the 9 and the 20, or some will say, I just want one, and they'll just use the 13. Is one better or worse than the other? Not necessarily. It's just, it's a matter of your preference. The simple moving average, the most popular are the 50 and the 200 SMA. Some people like the 100 as well. Those, again, are the most popular. If you want to learn more about them, just go over here and type in EMA. Let's see, EMA. What is the exponential moving average or moving average down here? You can type in SMA and read all about it. Simple moving average. But basically what it looks like is, let's see if I can find a better look for this. So it's basically these lines that you see here. They're lagging lines over periods of time. And this one right here, it's the average of a period of time on the daily. It's the average of a period of time on the 5 minute and then on the 1 minute. Again, if you look up over here under studies, edit studies, you'll see I have the 50 and the 200 simple moving average and the 9 and the 20 exponential. Again, it's a matter of what your preference is. Make sure you take our courses to really learn about them. But you'll see the 9 is the 20, or the blue is the 9 EMA, the red is the 20, and I think that's purple down here, or that might be the purple one down here. You'll see the 200 is up here. So they're all areas of support and resistance. So this area right here, this black line, is an area of resistance. This 9 that's now pointing out is an area of support. But there's also these candlesticks as well. So the moving average lines act as support and resistance areas. Again, it's going to be a matter of your preference, which ones that you use. But those are just the most popular, and traders are aware of them. So they look at those areas on the daily, they map them out, then they look at the areas intraday, and they watch, again, these areas, watching price of just, as you can see, kind of just moving throughout the day, going up and down, and touching these moving average lines. The farther price is away from a moving average line, the more it wants to gravitate back down to it. This blue line is the 9 EMA. The red line is the 20, and in between would be the 13. So you can kind of get an eyeball, a gauge where price is. You can see price right here, way above the 9. Naturally, it wants to gravitate back to the 9. It might fall to the 13. The 20 is a really big line of defense. When a stock breaks below the 20 intraday, that's potentially not a good sign, but not always. As you can see, a lot of times it'll break down and then the buyers will come back in and it'll continue. But it's just a constant battle between buyers and sellers intraday with day trading. Buying at support, selling at resistance. Exponential moving average lines and simple moving average are very, very important. Now, VWAP is another very, very important indicator. VWAP, it's kind of like the stock's equilibrium price throughout the day. So it's kind of like, I'm not the best with techie terms. Again, if you want to go over here to Investopedia, it's VWAP, volume weighted in, average price. It's basically the average price of the stock throughout the day over that period of time. So as you can see right here, this green dots is what I've added over here. It's kind of the stock's equilibrium price. We're kind of, the more stock, the farther away it is from VWAP, naturally at some point it wants to gravitate back to it. Doesn't mean it will, but you can see something like this. If it's far away, it kind of starts gravitating back to the 9. Obviously, that's a first line of defense, and the 20. And many times it'll come down, and sometimes a lot of times it'll bounce off VWAP and continue forward. When price is above VWAP, it's bullish. When it's below VWAP, it's bearish. But traders, this VWAP is another very important intraday support and resistance line. So not only do you have candlesticks, you have patterns, you have EMAs, you also have this VWAP, which is a very, very important indicator to look at. I put that right behind the EMAs, right behind the candlesticks. I say again, the candlesticks are your first line of defense, followed by the moving average lines in VWAP. So again, it's looking at the whole picture of support and resistance, and traders really pay attention to VWAP. The farther away a stock is above VWAP, the naturally it wants to gravitate back down. Again, there's no prediction of as to if or when it's going to do it. And then the farther away it's sold off, the more it kind of wants to gravitate back up. RSI and Bollinger Bands. This is basically just a gauge of when a stock is overbought and oversold. As you can see over here, let me go over to right here. So this is the SPX. Oops, this is not the one I wanted. Let's try this. SPX. Oh, this is the one. Oh, wait. Let me do, hold on a second here. Let me go over to with Bollinger Bands. 1 and 5 in Bollinger Bands. Okay. So you can see a stock when, you know, these Bollinger Bands are these bands that are outside of the price. This is kind of this gray line that I added, right? So when a stock is outside of the Bollinger Bands, whether it's above or below it, naturally it wants to come back in. So you can see kind of these areas of, let's see if this is a good indicator. Yeah, you can see here. See where a stock fell down over here? It's outside of the Bollinger Bands. It naturally wants to pull back in. Let's see if we can find an area where it's overbought. Right here. See out here? Over here, it naturally wants to pull back in. So it's natural overbought and oversold areas. Obviously, you can see when it gets over here, it's overbought and wants to pull back in. Once it gets outside of these clouds, it naturally wants to go back in. Now, it's a matter of when. That's where you're going to watch. Sometimes you might get 5, 6, 7 candlesticks. It might run for a half hour and then pull back in. So that's where you have to look at support and resistance and kind of looking at the gauge overall as to when it's going to do it. So Bollinger Bands are a good eyeball for support and resistance. Let me see. I saved this chart the other day. Why it's not showing me RSI, not sure, but I'm going to just do this. I'm going to go to Edit Studies and type in RSI, which is Relative Strength Indexed. Hit Apply, and here you go, right? Right above, there's a yellow line right here. Let me just go in and edit this so you can see it better. Let's see here. Oops. Let's see here. So you can see these lines, right? When it's over 70, a stock is overbought. When it's below 30, it's oversold. So obviously the more a stock is overbought, naturally people take profit and it kind of pulls back. The more a stock might be going oversold, the more buyers want to come in. Let me just see here. Let me just do this. So as you can see right here, look at this. Really oversold down here. You can see really oversold. And then it kind of turns around and the buyers kind of come back in. This right now over here, it's really overbought. At some point, it's going to want to pull back. So it's always a battle of buyers and sellers. Buy low, buy low, sell high, right? But a lot of traders will buy high and then the stock will go and it'll crash on them and they're selling low. So we'll see a stock like this. Many newbies will come in and be like, oh man, I got to get in. This thing's moving. And then it's right at a resistance level. And then the stock just crashes right back down, here. So like you can see it's got this big run. Someone's like gets in and it's, oh, let me get in right now. It's $8.50 and this thing 2 days later falls back down to $6 and they freak out. Well, the whole thing is a lot of people will blame the market, right? They'll blame the market for their wins or their losses. So like, let's say when the market's going, they're making money, right? They're all happy. Oh, the market's doing great. But then they lose money and, oh, it's the market's fault. The market's fault. I'm cursed. The market's fault. Well, the market is unbiased, right? The market is just information. When you're trading, you're making the choice. It's people, right? It's people and machines, 60 or 70%. I forgot the statistic. It's either 60 or 70% of trading is mostly algorithmic trading through computers, right? Which is emotionless. So it's not the market. The market is just going up and going down, and it's just providing information. The market can't help you, and the market can't hurt you. It's your decisions, it's your emotions when trading that creates the result. So it's not the market's fault, it's your fault. And I don't mean that in a bad way. It's just every single choice you make when trading is your responsibility. It's not the market's. Again, it's people. You're going up against people and computers, and all it takes is one person in the world to completely change the dynamic of a stock. So that's very important when trading. Again, why it's so important to manage your risk and always choose your proper entry and exit strategies. So again, that's RSI and Bollinger Bands, just kind of another gauge of when a stock is overbought and oversold. Overbought areas, oversold areas, usually buyers at some point come in. Sellers come in, usually at some point when a stock is overbought. Again, this can run for a couple of days, but what goes up must come down, and what goes down must at some point come up. And that's kind of the whole thing between buyers and sellers. News catalyst. Benzinga is our favorite news site. Now, news, right? There's a couple different things. You can have news over here. News is a catalyst, right? When stocks go up or down, a lot of times drastically based upon news. A lot of times they'll move up or down based upon a technical breakout, but news is a catalyst, a big catalyst to make a stock go up or down like this. So you can see Thinkorswim has a decent, they have just basic news over here that you can add on here. But Benzinga is our news site of choice. This is awesome. This is breaking news. Look at this right now. It's just all of the things that are happening right now. They also, so basically so you see this? It just pops up so quickly, shows you. You can edit all of these things. You can edit the price, the symbol, all of that. But look at this. This is all breaking news. It's just it's an incredible tool. They also have a feature called Squawk, where if you click on it, you can listen to radio. You can click right up here. I got to turn on probably my speakers on this, but basically you can listen to live news, right? Oh, that means usually something's coming up. So that's a news, that's an alert to let you know of something that's happening. And then a lot of times they'll read the news live to you, so you can hear it happening. So if you're trading and
PHG Phillips getting a downgrade at JP Morgan to a neutral. That's Papa Hotel Golf.
Hear that? So Papa Hotel Golf, look at that, PHG. He just read you the news. So that's exactly my point. So the Squawk box on Benzinga is awesome. So now you could be trading. You can hear him reading it out. You could pull up a chart on PHG and see what's happening. So let's see, for the heck of it, let's just pull up PHG, see what's happening. PHG, boom. It's falling right now. Let's see why. Moved down and right over here. So it's telling you what's exactly happening. So if we stayed on this for a little bit, you'd hear him reading positive and negative stuff. Oh, there it goes. See that? Hearing JP Morgan downgrades Phillips from overweight to neutral. Obviously, that's breaking news. It affects a stock. So again, going back to what we're talking about, when you're a trader, you need tools. There's no way around it. If you want to be a good trader, especially a day trader, and you're not using proper tools and you just want to wing it and use all the free tools, you're not going to become a successful trader. Just like with anything, be a good builder or a dentist or doctor, you need to have great tools. Benzinga is a great tool. Oh, here we go. I'm going to get rid of that. That noise is annoying to me right now. But Benzinga, again, breaking news site of choice. You can have this up, listen to what's actually happening. When news breaks, it hits a news wire like Benzinga. Obviously, you see all of these different ones over here. When I'm over on Trade Idea or on Thinkorswim, it's just specifically on what stock I'm looking for. See the difference? So I'm looking specifically, whereas over here, I can see it breaking live real time. Big difference. And now this is why, so when a stock gets breaking news, the news wires pick it up, right? Then traders see this news and then they decide whether they're going to get in or get out of the stock. Well, what they do at that point, when they get in and get it out of the stock, what does that do? It creates volume, right? So when buyers and sellers come in, it creates the volume, and that's what creates, again, the news catalyst. So when news hits, buyers come in, creates the volume that you see. So it's a very symbiotic relationship between Benzinga and then a tool like Trade Ideas. So then the news hits the news wire, buyers come in, or sellers, creates volume either way, and then it hits Trade Ideas, the scanner. High volatility. Going back to our picture, you can see float over here. Anything under 10 million, super volatile. Under 20 million, still volatile. 50 to 100, medium range, and then these white ones, kind of a little bit slower over 100 million float, makes it slower. And on Thinkorswim, I added a thing called shares over here. Shares are basically shares outstanding, similar to float. It's a little bit higher than the float. So it's just a good gauge. It's an eyeball gauge that I like to look at. So just be very aware of the float. Again, lower float, higher volatility, more risk, more reward. Also, more risk equals potentially more losses. That's why risk management and setting up your proper risk management is absolutely key. So the gap and go, basically what we're looking at is in the morning when we look at Trade Ideas, we have our gappers set at a minimum of 4%. So we don't go through all these. Sometimes we just kind of get an eyeball or a gauge. We look again at the gappers, the highest gappers with volume. We want to have at least a minimum of a 4% gap. What does that mean? A gap means, a gap above yesterday's close. Let me just see if I can just do this here. Gapper would be a perfect example of, let's say this is yesterday's close over here, right around 503. It gapped up this morning. See, it's gapped up. There's a gap up. That creates, obviously, it gets on the scanner. People take notice. Then you look at the patterns, and then you see what happens when the market opens. So we're looking for, scans each morning that have at least a 4% gap up. So sometimes when we do a watch list the night before, nothing will move. And then, for targeted, these are like usually my Trade Ideas ones. So this is kind of my watch list last night, and then Trade Ideas today. And you can see some of the ones on Trade Ideas had more of a higher percentage. They probably, again, had news or a catalyst, whereas maybe yesterday or the day before there was news or the catalyst on my watch list ones, and now this might be potential continuation. So, gap and go is searching for stocks, again, minimum at 4% at open. They're gapped up. Volume, usually it might be due to a news catalyst or just a technical breakout. So you want volume to, because again, traders are searching for volume. So that's kind of how we use Trade Ideas. We look at Trade Ideas every morning. They find the gappers. I mean, and look at this. This is just incredible. And then we compare it. We pick a handful off of here that are going to go on our watch list. And then we kind of do something like this, where we have a target of a handful of stocks that we're looking for, and we're just watching, right? We're mapping out support and resistance areas right over here, and just kind of watching what a stock is going to do. And it's all, again, buying at support, selling at resistance, not getting too greedy, take your profits. We always like to say, always take your profit. So red to green, that's when a price crosses above the previous close line. Traders they're very aware of red to green and then green to red moves. So again, when a stock breaks above a previous close line, let me see if I could, let me go back to, this is the chart I always use over here, 1 to 5, here we go. Yeah, I'm just more used to seeing this. I tried for the videos to show you guys that, but it kind of throws me off because I'm just so used to my setup here. This orange line is this line that I have for previous day's close. So you can see right here, this would be a red to green move, right? When a stock falls and now it's falling below this line, green to red. I don't know what I just said. Green to red when it's falling, right? And then when a stock goes and it breaks above, let's see if I can get a better example. So right over here, when a stock goes from red to green, right, it's above that orange line, and it, a lot of times it'll go up. My point being, with red to green, traders watch that. They look at these levels, whereas I'm not seeing really ones that are close. If you see ones that are like around 0% maybe, like maybe around this right here. Let's take a look at CEE. Look at this over here. You're seeing how that's close to 1% or close to 0. You'll see that it's hovering around yesterday's close. So it's bouncing off. It's still green right here. But if it falls, it could be red. It would be red. So let's see this one right here. This is green, or this one is red. It fell below yesterday's close. That's kind of an ugly looking stock. But red to green, obviously there's nothing really close to it right now other than this one right here, CRNT is probably the closest. You know, again, it's getting closer to this potentially going positive. So my point being in it, red to green, another area of support and resistance. When a stock goes above yesterday's close, that's green. When it falls below previous close, that is now red. Green to red, red to green. And let's see here. Long or short, bull or bear. Basically, the market is always full of just buyers and sellers. It's a tug of war between buyers and sellers. Being a long or a buyer, you know, a bull, or being a short, which would be a bear, right? What's better or worse than another? Really, no one can tell you that. It's just a matter of your preference. Usually, traders fall to one more, more of one bias than the other. Ideally, you want to become good at bull strategies so that when the market goes up, you can be a bull, and when the market goes down, you can be a bear. But traders tend to be more one biased over the other, but that's something that you will, over time, learn to be more comfortable with. So that's, again, more of your choice, not necessarily what's right or wrong. Dip buying at support levels. So if you don't want to be a short, and you just want to be long bias all the time, when a stock is selling off, let me see if I can find one to take a look at. Instead of shorting it, you can buy when a stock falls down to support levels, right? This might not be the best area to kind of show, but you can see a stock's falling, created a support level, and then you can see buyers kind of came in. This might be one right here. Again, I wouldn't say to buy this one per se, but you say buy at supporters. So instead of, like, let's say you didn't want to short it at a top on the way down, you felt more comfortable just being a buyer. When a stock finds these support levels, you can do what they call dip buy at a support level, and then sell once it gets up to more of the resistance level. So again, if you don't want to short, you could be a dip buyer. Dip buying is very popular. When a stock sells off and panics at the open, usually at some point it'll find support, and then the buyers might tend to come back in. At some point they do. So again, a stock selling off, bear flagging, kind of finds support. This is not the best one, but you can see it's a good way to manage risk, right? So if you bought, let's say, at a support area like this, you would risk that area as your stop loss. So if it kind of went further down, obviously you want to protect your losses, but this is not the best trade to look at. But again, dip buying, when a stock completely sells off of the daily and finds a support area, or intraday, same exact thing. So dip buying is just another strategy of buying at a support level, selling at a resistance area, whereas a lot of people, might not be comfortable shorting at a top, so they like to just stay long, or they like to be buyers at all times. You could buy when a stock's going up, but you can buy also when a stock's going down once it's found a support level, which would be a dip buy. Hotkeys helps you to get in and out of trades quickly. I am a huge fan of hotkeys. TD Ameritrade, they have terrible hotkeys. They just really have basically buying and selling. They don't allow you a buffer. See, I like to have a buffer. So when I put my limit order in, I usually have a 5-cent buffer. So let's say, for instance, if I was going to buy, at this one right here, 338, I can put my limit order in like this, and have it be manual, or I could put it in like this. Like I could put it at 5 cents above. So I can do my limit order like this. Let's say I wanted to wait for the stock to go and break above 338, and I wanted the bid to get up to 338. I could put it at 343, so it gives me a little bit of a buffer. Let's say the bid got up to 338. Now the ask is going up a little bit higher. I give myself a 5-cent buffer to see if that bid holds and is going to continue up, and then I can, boom, hit buy. It gives me a little bit of a buffer. Or I have hotkeys. So this is with the limit order. I have hotkeys. Again, also to sell, I might put it 5 cents below the bid if I was to do a limit order. But once I'm in a position to get out, I'm usually using hotkeys. So I have my hotkey set up by default to have, buy 5 cents above the ask and sell 5 cents below the bid to give me a buffer, So again, if a stock I was trying to sell at 336, it's going to put it in at 331 and it'll give me the best fill just in case the stock is falling down. Again, same thing with buying here if the stock gets good momentum. I like having a 5 cent kind of buffer. It's all a matter of your preference though. Hotkeys enable you to get in and out of the position very quickly rather than having to kind of do this like you're watching. You're like, oh man, the stock's going up. Let me just move this, or let me go in here and just let me type in, and by that point you could get all screwed up and just start freaking out because the stock's moving so quickly. That's why I like hotkeys. I usually put a limit order in where I'll kind of get in most of the time using my position, using this montage window, and then I get out using a hotkey. Again, it's all a matter of your preference, but I use hotkeys with a 5 cent buffer. Again, on Thinkorswim, their hotkeys are terrible. I don't like Thinkorswim's platform trading. Really, it's decent, but just to give you an example, let me show in the sidebars. With Thinkorswim, they do have this, which is really nice. If you click on trade, you got to set up your platform a little bit differently, but you can go in here. This is buy market, sell market, but if you go in here, you can add buy the ask and then sell the bid. Hit OK. So now you can hit buy the ask, sell the bid, and then you can put number of shares over here. And then so you can literally, this is like a hotkey, buying the ask and selling the bid. You just can't have the buffer on it. So this is good. With Thinkorswim, I do like this. Again, take our Thinkorswim course to really learn how to do this all intricately. I don't, again, trade with Thinkorswim, but buy the ask, selling the bid, those are basically like hotkeys. So that's how you would do it with Thinkorswim. But you can also do regular hotkeys, like set up the hotkey to do the same exact thing. I actually just like those buttons the way they are with Thinkorswim. But also with DOS, again, they have a virtual platform just like this as well. So I'm actually logged into my virtual account here now, which looks just like my real account. But again, you can kind of play around with it here. You can make these like hotkeys as well. Again, it's all a matter of your preference. I don't even know, what do I do? Like Alt A to buy and Shift S. I can't even think. I'm just so used to doing it. Shift S to sell. That's just what I'm so used to doing, right? It's just kind of a natural comes naturally. It's all a matter of your preference, but bottom line, hotkeys get you in and out of trades quickly rather than having to fumble around with a limit order. So I highly recommend hotkeys. Thinkorswims are terrible. Interactive brokers are decent, and DOS traders are excellent. So SPX chart, have it up when trading. Give you an example. So when I'm day trading, I usually have SPX or /ES, a futures chart, to show you what's happening. Obviously, this orange line is previous day's close. Price is down today. You can see it's a down day. So again, most of these stocks, when you're day trading, the majority of them run with the market. So if the market's down, a lot of times these stocks will tend to be down. Sometimes, they'll go against the grain with some news, but overall, it's nice to see what's happening in the market. You can see the market's completely selling off here. Chances are many of these stocks will probably be falling down with it. So that's why it's good to always have an SPX chart up when you're trading to give you a gauge of what's actually happening in the market. Setting up alerts, very important. Again, we send out our watch list alerts every day over here. These are for both day trading and swing trading. Having alerts is awesome. Where basically you can go in over here, you can see under Market Watch, you'll see a bunch triggered today, right? So how you go and you create an alert, you can set it up by setting it up to go to your cell phone as a text or by email. But all you would do is when a stock falls or goes above a certain breakout level, you can create an alert. So right here, FRTA, the high of day today is 853. If I hover over it and I hit right click and create an alert, I can go alert me when the stock, if let's say, alert me when FRTA is getting close, let's say at or above 851, right? Now it gives me an alert. If that alert triggers, it's going to pop up on my screen here. And then I can also go to setup and I can add my email or text to alert me when that happens. So alerts are very important, whether you're day trading or swing trading. It's a great way to keep an eye on things. And again, we send out watch list alerts pretty much every night. So take our watch list and then you go in and just input the alerts that we show you. As you can see, we send these out each day. And you can see like at or above 105, 850. You would just go to the charts right over here, mark out the areas we say, create the alerts, and then obviously let yourself be notified when the alerts trigger. Trade Ideas pre-market scanner. Again, Trade Ideas is our scanner of choice. It is the best. We just cannot live without Trade Ideas. So we do our watch list at night, but just because we're doing it at night, everything changes in the morning because, as we said, Benzinga and those newswire services have news. They pick up on it. Then it hits Trade Ideas pre-market scanner. And as you can see here, this is what it looks like every day. Sometimes it'll be red over here. This is particularly a green day, a green morning, but sometimes it'll be red or sometimes there won't even be that many plays on it. Again, there's no way to predict what the market is going to do. The market is just giving you information and you react based upon that information. But traders are watching exactly what's happening here. Trade Ideas is one of the best scanners in the industry, and traders are looking at all this. They're going through, they're following the highest, they're looking at the biggest gappers, seeing the volume, the flow, and the news, and many of the traders are watching the same stocks. And then again, it's a battle of the bulls and the bears, right? Who's going to be in control, the bulls or the bears? And it's just that battle, and that's where you decide whether you're more of a long or a short or a bull or a bear. And then you pick your strategy, and it's all about scalping, not getting too greedy, protecting your risk, having at least a 2-to-1 profit-loss ratio, and making hundreds of practice trades until you become successful trading and not being a statistic.